So I talk a lot about just investing in index funds in general, and why don't business professors actually do some sort of complicated investment strategy? And I don't know too many people that do that, although I know that there are people that do that. I knew of one at my institution many years ago that actually did some trading, but then got in trouble with the SEC, the Securities and Exchange Commission. So why is it that we actually don't do this? That's kind of an empirical puzzle. I don't know if everybody is this way. I think, that there is a knowledge barrier with sort of doing this kind of stuff. So some people obviously might invest kind of like a normal person would, and that is totally fine. Like a normal person just being like everyday person, right? And that is totally fine, right? Like you can assume that everybody is a normal person. Business professors and all that kind of stuff are normal people. And you can assume that maybe that's what the reason is. But I don't think that's actually the reason. I think, if you look at what we actually do, right? Like we actually try to model behavior of companies. We actually try to look at how CEOs behave. We try to look at how company performance actually behaves. And, some of the papers that we actually work on, I empirically sort of can demonstrate some effects that I think are interesting in the market. And there's lots of people that look at that. That's called market performance. And they might look at sort of different techniques of, maybe looking at, what is called an event history, like pre-post some sort of event that happens. That's kind of common. But I don't think that there is a lot of professors that actually trade on the thing that they are researching. Now, there's good reason for that. Most of us, and I hope most of us, and maybe I am speaking far too fondly on most of us, are smart enough to realize that the world is a heck of a lot more complicated than how we understand the world. And, if you find an effect, right? Like, let's say you find, for example, I study recalls, for example. There's papers that show that recalls, leads to some down market performance. Now, if we find that effect, and I think that there is a solid effect there. I think most recall studies look at that. Why don't we trade on recalls, right? Like when a company issues recalls. Well, the issue is we're simply just not smart enough to understand the whole world, right? There is a lot that goes on, even above and beyond that one particular thing, that is just really hard to explain, and the world is extremely complicated. So that's one aspect of it, right? The world is just complicated. The other aspect that you have to realize is that by the time we get information on any of this kind of stuff, right? Like you might think that we're super sneaky, but that's not the case. We don't have some sort of inside information. We normally look at what is publicly available. And if there's something that's publicly available, some information that's there, that means that everybody else knows about that. And there's smart traders that would look at that. But, on top of that, there's also machines that would be looking at this and sensing any sort of market changes that might happen. If somebody actually buys a large number of stocks for something, then the machine is going to be triggered and they might sort of counteract that particular thing. So the dynamics within a market is really, really hard to figure out. And, it's really tricky to sort of put your finger on what is the right thing to do. And even though that maybe consistently we might sort of perform in certain areas, in terms of market performance and make some money from it and all that kind of stuff. In general, it's just really, really tricky to ever do this. you need an awful lot of computation. You need a lot of information to actually do this correctly. So that's the thing, is that I would never gamble anything substantially on what I actually know, because the world is a lot more complicated than I'd ever assume it to be. And or I assume it to be a lot more complicated, and sometimes maybe it's not, but often it actually is if you start looking at it. And maybe I can, do extremely well by playing those games, but I would never bet any money on it of any substantial value. Now, the only thing that I would bet on is the things that I talk about, right? Like getting index funds, mutual funds, really broad-based, funds of some sort, and then that sort of slow incremental grind. Like, those are the key things that I think are important. The models that I see, it's interesting, right? Like, I see a lot of research models and things like that, right? Like, I get to watch and listen to different presentations and, read different things. They're still very, very rudimentary, and that is on purpose, right? Like, the part of doing research is finding rudimentary ideas, really basic understanding. And the more basic it is, the better off you actually are, right? Like, that's the basic principle. So to actually execute on these things, in general, you're going to be off the mark. The basics of it are there, but the world is just a lot more complicated than one would ever assume. It's like, some basic categorization of how human behavior actually works, or how nature actually works, right? Like, this is some sort of species of a tree, right? Like, some sort of really generic thing might cover a lot of stuff, but the specific moment of what you're actually looking at is going to be hard to narrow down the nature of what that tree is, right? Like, you're going to, place a bet on something and how tall something would be based on the species of the tree, and you can sort of assume it's going to be a roundabout area, but you can't put a specific bet on it. You cannot guarantee it's going to be something that is, some specific amount, and that is more symptomatic of just basic statistics, because there's always outliers, and frankly, the tools, the empirical tools that we have, are just not that good statistically. And they're designed that way on purpose. So we're looking at general sort of trends and general things that are wide swiping things, but those don't explain a lot in this world. And if they do explain something, it's within a complicated, complex system that surely is violated often. Even when we try to control for a lot of different things. And so this is actually some of the nuances of research that makes it really tough. So hopefully you learned a little bit. It's the basics, the sort of simple things over time, building competencies, slow going. That's the only thing that I can really say for sure that actually will pan out in the long run. And then the other thing is, really broad-based sort of risk minimization strategies. That's about it with this. Is that's all you're trying to capture and trying to do. And if you did those, you're far above most people. And that's the other thing to remember, is that most people are never going to play these games. They don't really get it. And even if we did very simplistic ideas of, just diversify, buy index funds and mutual funds, broad-based mutual funds that are really good. That's far and above most people. That's a good strategy in that case, right? Because what you're trying to do is just do what everybody else would overlook, right? And so you're whittling down, to get to a extraordinarily above average performance. Just do these sort of simple things and you add them up and they compound together. You will get an extraordinarily above average performance in the long run, repeatedly. All right, take care and have a wonderful day. Bye.